Most people think retirement requires crypto luck, trading skill, or a six-figure salary. Others believe that you need millions of dollars invested so that you can withdraw 4% a year just to survive retirement. But friends and family, did you know that there's a boring dividend growth ETF that can help you, that can help me retire early without having to sell anything at all? And you don't need a massive portfolio to make it work. Her name is SCHD. But why exactly SCHD? Well, it has 100 quality companies, for the most part, ranging from Chevron being the biggest company of 4.4% of the portfolio, to ConocoPhillips, Merck, Coca-Cola, Texas Instruments. Most of these companies are dividend compounders with cheese. Now, obviously, if we scroll all the way down to the bottom, position like number 100, 0.02%, Amerisafe or Capital City Bank might not be the highest quality, but they don't really make that much of an impact on the overall holdings. So by being an ETF that consists of 100 companies, it diversifies away your risk, but also it helps blend out the average to be something that's respectable with a capital R. Reason number 2, I'm a really big fan of the screening metrics to be included. So SCHD follows the Dow Jones US Dividend 100 Index, and as you can see on your screen right now, they prioritize all the different publicly traded companies. In order to be a part of the final 100, they grade you and evaluate you based on your cash flow, whether or not you have a stellar return on equity, your dividend yield, but also with an emphasis on the dividend growth rate. And a really important factor about SCHD is that once a year, around March, they have their annual reconstitution, which means they change up who belongs in the 100 companies that comprise SCHD. If you're beautiful and you're a dividend compounder with cheese, they might add you. For instance, this year they added 25 new companies into SCHD while kicking out 22 companies. And that's the beautiful aspect of SCHD. Because even if they do hold a company that might not be the best of the best, they'll kick you out if you start to go south. So for the 12 months where you're a part of SCHD, they'll thank you for your service while you contribute your dividends. But the moment your financials and your fundamentals start to show cracks, you're out of there. They do the hard work for you. But I think a fair question is, will this even work? Because what I've been told on the internet is that dividend investing doesn't really work, it underperforms. Well, when we talk about the performance of SCHD, since inception, 13% is the CAGR, the compound annual growth rate, how much your money would have grown year over year. I don't know about you, but 13% sounds pretty fantastic to me. And last but not least, the most important reason as to why SCHD, imagine when you stop reinvesting the dividend payouts to buy more shares, but instead you use that passive income to cover your living expenses. Let me show you what I'm talking about. But before we get there, let's take a look at their dividend profile. If you buy into SCHD today, it'll set you back $30 a share. And your dividend yield for today is 3.4%. If we round up, we can say 3.5%. And the growth rate of 1.5% right there, it's not accurate. Visually depicted, over the grand scheme of things, the dividend payout does go up year over year. Now, obviously, there's little dips here and there, and that's because the companies that comprise SCHD, it switches up and it changes every 12 months. So depending on their timeline and when they decide to change the dividend growth rate, it all gets factored in and it contributes to SCHD's historical dividend growth rate of 10%. And I absolutely hear you, a 3.5% dividend yield, it's not the highest, but if you buy into it today and I let my investment in SCHD to marinate for 10 years, then my yield on cost would be a lot higher, meaning my dividend yield for SCHD would be a lot higher. Matter of fact, if you bought into SCHD 10 years ago, your yield on cost for the original investment would be about 7.8 to 7.9%. In fact, let's go ahead and take a look at that right now. So going off the assumptions of the US median household income of about $84,000 and our starting capital being $10,000 being put into SCHD on January 2017 and letting it cook for 9 years and 2 months while at the same time contributing $500 into the portfolio every single month or about $6,000 annually, what would have happened? Well, let's scroll down and take a look at that. That initial $10,000 would have transformed into $37,363. The annual CAGR would have been 15.3% for the past 9 years. So try to talk to me about how dividend growth investing doesn't work. Because I don't know about you, but having my money grow at a rate of 15% year over year for the past 9 years, sign me up. That sounds pretty good. And in the best year, in 12 months, 29.8% was the performance, and then in our worst year, our portfolio by negative 5.5%. And if we look at the $10,000 visually depicted, we could see $10,000 growing to $16,000 in December of 2019, growing to about $32,000 at the end of 2024, and then roughly $37,000 at the time of making this video. The worst year's performance would have been in 2018. The best year would have been 2021. And needless to say, this is recency bias, but year to date, SCHD for the past 3 months, it's up 12.8%, and it's probably one of the better performing investment choices out here in the stock market, and it's a testimony to value investing actually working. But let's keep in mind, that's the past. What about if someone were to start today with SCHD? Now, even though SCHD's historical performance in CAGR is 13%, of which roughly 9% is the share price appreciation, and the dividend growth rate is about 10%, well, in actuality, the 10-year CAGR for the dividend growth rate is 10.4%, but we'll go ahead and round down and say 10%. Let's go ahead and say that I put $10,000 into SCHD today and assume that the share price will appreciate by 7% year over year, and the dividend growth rate will be 7%. And just keep in mind that I'm intentionally using conservative assumptions so that we're not relying on perfect market conditions, and to bake in a little bit of margin of cushion. That way we're not assuming things with a rosy tinted glasses. And then every single month we'll be contributing $500 or $6,000 annually. Well, what would happen after 30 years? Right now I am 35, so I would be 65 at the end of this experiment. Well, I think the results are pretty amazing. That initial 10 grand would have transformed into $1.2 million under the assumption of reinvesting the dividend payouts. And the annual dividend income at the end of 30 years would be $42,700. The monthly dividend income would be $3,500. And the yield on cost, my dividend yield, would be 22.5%. So even though SCHD's current yield is 3.5%. For the folks that bought into SCHD 10 years or 15 years ago, I am telling you, their yield on cost would be a lot higher. And that's why I think SCHD is a suitable investment for retirement. And if you take a look at the total return breakdown of that $1.2 million, who did most of the heavy lifting? The share price appreciation contributed 57% of that performance. 700 grand contributed towards that. The reinvested dividends, 27%, $300,000 of dividends reinvested back into it to allow the snowball compounding machine to just get bigger and bigger. And my own money contributing $500 every month, $180,000 would turn into $1.2 million by letting time in the market do the Gordon Ramsay cooking as necessary. You don't just put something into the oven and then just pull it out the next day. Yes, I'm talking to you, day traders. No, when you think about dividend growth investing, not only do you marinate the meat and put the spices, the flavor, and the seasoning all over it, but you gotta give it time to bake, to allow the juices to really resonate all over the meat so that it's more tender and delicious. That takes time. So right off the bat, I'm telling you, to do this, it requires discipline and patience. It's not a get-rich-quick overnight kind of a thing. No, it's never going to happen that way with SCHD. Matter of fact, to take it a step further, this will only work if I am consistent. No matter what's happening in the market, no matter who's sitting in the presidential office, no matter what's happening in the workplace where someone cut me off in traffic, if I just continually, consistently contribute $500 every month into SCHD with an initial principal amount of 10 grand, 1.2 million, I would be, on paper, a millionaire at age 65. Initially, with the $10,000, that would yield me 327 shares. And so the dividend income right off the bat would be $345 a year. If we are going to be honest, that's not enough to cover living expenses on an annualized basis. It might be enough to cover the Netflix subscription. But as we fast forward throughout the years, just taking into account how that dividend income grows, I think by year 24, if your mortgage is paid off and your cars are paid off and all you really have is just your utility bills, your trash bills, your cell phone bills, a $22,800 could be enough to cover at least 80% of your living expenses. Once you factor in Social Security benefits, your 401k and everything else, it could bridge the gap, right? But most definitely by year 30, $42,000, I think that's more than enough to cover living expenses. Now, something that I do want to call out is the yield on cost initially is 3.4%. That would be the dividend yield of SCHD today. But if you take a look at what happens over time, my yield on cost, let's say year 15, my dividend yield, my investment into SCHD is an 8% dividend yield. And if we fast forward to year 30, my yield on cost is 22%. Now, all of this is under the assumption of a $10,000 starting principal amount. But let's go ahead and assume that I have a little bit of cash saved up and I decide to put in $25,000, and keeping everything else equal, that would yield me 818 shares right off the gate instead of working with 300 whatever shares. Then what would happen? Well, after 30 years, that 25 grand would transform into 1.5 million. And friends and family, the annual dividend income would be $52,000. I think $52,000 is pretty juicy, right? Yield on cost, 25%. Monthly dividend income, $4,300. But let's go ahead and assume that we're above the US median household income and we're able to put away $1,000 into the brokerage account every month. Then that would add up to $12,000 a year. And keeping everything else the same, how would that change the results? Well, after 30 years, then our portfolio would go from $25,000 into $2.5 million, and the annual dividend income would now be $88,848. All I'm trying to say is I've been doing some research on places that I can retire off of just passive income. And there's parts in Latin America and Southeast Asia that'll allow it. But me, I've been eyeballing Europe for that quality of life. And come to find out, Portugal, they offer a D7 visa where if your passive income, your pension, your whatever it is, adds up to 920 euros a month, you qualify for that visa and you can live in Portugal. So that's what I've been eyeballing and thinking about, maybe that as my FIRE retirement strategy. And so I don't know about you, but with $88,000 in US dollars, by the way, the currency, to go and live in Portugal that has a very low cost of living expense, especially in comparison to San Diego, New York City, or even Seattle, I think I would live a pretty grand lifestyle in Portugal. I mean, wouldn't you say? And when we take a look at how that $2.5 million is broken down, 57% of it is attributed towards share price appreciation, almost 700 grand because of the dividends being reinvested back into the portfolio, and $360,000 of my contributions every month. And then, of course, the 1% from the initial capital of $25,000. And just for fun, let's just go ahead and assume that I'm a day trader and somehow after consecutive losses, I just win big. And I run into a crap ton of money after accounting for taxes. Let's say that the cash in my account is now $50,000 and I don't want to gamble anymore. It's too risky. So instead, I put it all into SCHD, $50,000 And I transitioned from being a day trader into being a dividend investor, keeping everything else the same. That 50 grand would yield 1,600 shares of SCHD. What would happen after 30 years? Well, that 50 grand would transform into $3 million, and the annual dividend income would be $105,000. The monthly dividend payout would be $8,700. So hopefully you're starting to see that with SCHD, you don't need to have $10 million or $20 million in order to have a retirement where you live entirely off of passive income generated from your brokerage account. It's possible. Obviously, it takes time, right? 30 years. And this style of investing, it's not sexy, it's not flashy, you're not going to be a millionaire overnight. And it's not artificial intelligence or space satellites or cryptocurrency or any of that jazz. It's just dividend compounders doing their work in the market for you by SCHD, filtering out high-quality compounders and extracting the dividends from those businesses. But once again, I do want to emphasize that your portfolio's valuation is not going to consistently go up by 7% year over year like we put right there. Sometimes it'll go down, and other times it'll go up 29% like it did in the past. But for the most part with SCHD, it's slow and steady, and the data shows us 13% year over year, accounting for the dividends plus the share price appreciation. And the best part about SCHD and using that as my retirement strategy, you do not have to sell shares and reduce your ownership in order to create a synthetic dividend like most financial independence retire early community folks think like you have to do. You don't have to sell your positions in Microsoft, SCHD, or any of this. With SCHD, you just hold on to your assets and allow it to work for you. So what you own produces cash flow for you. It's kind of like the best way I can describe it is you owning a rental property that pays you every single month, or Airbnb-ing a home that you already own. You wouldn't just necessarily sell it at the end of the year to create income, right? Instead, people would come in and out of your property and they would pay you because you're the landowner. And that's what I kind of see SCHD as. By owning SCHD, it pays me every 3 months, and eventually it'll be enough to cover my living expenses. If I could go back in time, when I was a cadet at a military academy, I used to earn a monthly stipend. It wasn't much. I think it was like $350 or $400 a month. I would have consistently invested part of that paycheck into SCHD. Because if I did that, my portfolio would be so much bigger today had I started at age 18. Unfortunately, I didn't know anything about investing back then in 2010, 2011. In fact, I didn't start investing until my late 20s. And between you and me, that's one of my bigger regrets in life. But hey, better late than never, right? I think I'm doing all right now as a stay-at-home dad. I mean, I could always use more contributions, active income going into my portfolio, which I only make about $200-ish a month on YouTube. But working with what I've got, I feel pretty grateful. I'm happy about the CAGR. I'm happy about the performance. Speaking of which, if you want to see the public portfolio, my holdings, the rationale, the investing thesis and everything, check out the playlist. Other than that, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you very soon.